Herd behavior, FOMO, narrative contagion, and the psychology of bubbles. Introduction: The illusion of independent thought. In the late stages of every financial boom, there is a moment that feels almost serene. Prices are rising, headlines are optimistic, analysts sound confident. Your friends are discussing opportunities with excitement rather than caution. It does not feel chaotic. It feels intelligent. It feels justified. It feels, above all, rational. And inside that atmosphere, doubt begins to feel irrational. You may even hear yourself say quietly, "I know this is getting expensive," but then another voice answers, "Yes, but everyone sees it. It must still make sense." This is the paradox. Intelligent people, armed with data, experience, and analytical skill, often end up copying the crowd, even when they know better. Why? Why do we imitate collective behavior in markets, in business, in trends, even when logic suggests caution? Why do bubbles expand with the participation of highly educated investors? Why does fear spread faster than facts? Why does enthusiasm feel contagious? The easy answer is ignorance, but ignorance is rarely the cause. The deeper answer is social proof. Social proof beats logic. Human beings are not designed to operate in isolation. We are social organisms whose brains evolved to detect consensus as a signal of safety. If many people believe something, our cognitive system interprets that belief not merely as information, but as validation. Consensus reduces uncertainty. Agreement lowers perceived risk. Collective enthusiasm dampens individual doubt. In uncertain environments, and financial markets are among the most uncertain systems on Earth, we lean on others as navigational tools. It feels intelligent to gather information from many sources. It feels prudent to observe what others are doing. It feels responsible not to ignore broad agreement. But somewhere along the line, observation becomes imitation, and imitation becomes amplification. This is where markets transform from analytical arenas into psychological ecosystems. The economist who explored this dynamic most powerfully is Robert Shiller. Shiller did not merely study interest rates or price fluctuations. He studied stories. He argued that economic movements are not driven solely by fundamentals, but by narratives, contagious stories that spread like viruses through societies. He called this framework narrative economics. According to Shiller, financial booms and busts are not just mechanical reactions to data. They are waves of belief. Stories about technological revolutions. Stories about housing always going up. Stories about new eras of permanent growth. These narratives spread from person to person, media outlet to media outlet, until they become common sense. And common sense is powerful, because once an idea becomes socially embedded, disagreeing with it requires psychological courage. To step outside the crowd is not merely to disagree with a spreadsheet, it is to risk social isolation. It is to risk being wrong alone. It is to endure the discomfort of watching others profit while you hesitate. That discomfort is not intellectual. It is emotional. We like to believe that markets reward logic. In theory, they do. But in practice, markets are environments of incomplete information and constant ambiguity. In such environments, humans revert to ancient survival mechanisms. One of those mechanisms is imitation. If everyone runs, you run. If everyone buys, you buy. If everyone celebrates, you celebrate. The crowd becomes a proxy for reality. And inside the crowd, behavior feels justified. This is why bubbles rarely feel irrational while they are inflating. Rising prices validate belief. Media attention reinforces excitement. Experts construct frameworks that rationalize momentum. Gains create confidence. Confidence attracts participation. Participation pushes prices higher. It becomes a self-reinforcing loop. From the outside, historians later describe it as obvious. From the inside, it feels coherent. The most dangerous part is not the crowd itself. It is the illusion of independence within it. Most participants do not believe they are copying. They believe they are deciding. They believe they have evaluated the data. They believe they are acting logically. And yet their decisions align almost perfectly with the surrounding social atmosphere. This is not stupidity. It is structure. Our brains are optimized to value social alignment. Social belonging historically meant survival. Social exclusion meant vulnerability. Even today, subtle cues of agreement and disagreement trigger deep emotional responses. Approval activates reward circuits. Isolation activates stress circuits. In markets, these mechanisms operate invisibly. You do not consciously think, "I am copying because I fear exclusion." You think, "This makes sense." And that is precisely why herd behavior is so powerful. It disguises itself as reasoning. In this episode, we will examine why we copy the crowd even when we know better. We will explore the biological roots of imitation, the mechanics of herd behavior in financial markets, the viral spread of economic narratives, and why bubbles feel rational from the inside. We will examine how fear of missing out magnifies collective movement, and why resisting the crowd often feels more dangerous than following it. Most importantly, we will ask, is independent thinking in markets truly possible? Because understanding the crowd is not about condemning it. It is about recognizing that logic alone is rarely enough. And unless we understand how social proof overrides reason, we will continue to believe we are thinking independently, while moving in perfect synchrony with everyone else. Section 1. The Biology of Imitation. Why the brain prefers safety in numbers. To understand why we copy the crowd in markets, we must first leave the trading floor and travel back thousands of years. Long before stock exchanges, long before currencies, long before economic models, human survival depended on one simple principle: stay with the group. For early humans, isolation was dangerous. A lone individual faced predators, starvation, and environmental threats without protection. A group provided shared vigilance, shared resources, and shared defense. In evolutionary terms, aligning with the majority was not weakness, it was strategy. Over time, the brain adapted to treat consensus as a signal of safety. If everyone in your tribe reacted to a noise in the bushes, ignoring them could be fatal. If everyone migrated toward a new water source, staying behind could mean dehydration. Following others reduced individual risk. Collective movement improved survival odds. This survival mechanism did not disappear when markets were invented. It simply migrated into financial behavior. Social proof as a cognitive shortcut. Human cognition is energy efficient. The brain constantly searches for shortcuts to reduce mental effort. In uncertain environments, evaluating every decision independently is exhausting. Social proof offers a shortcut. If many people believe something, the brain interprets that belief as evidence. This is not a conscious calculation. It is an automatic inference. Many people are doing this. Therefore, it must make sense. Psychologists call this informational social influence. When reality is ambiguous, we look to others for cues about what is correct. The more uncertain the environment, the more powerful this effect becomes. Financial markets are environments of extreme uncertainty. No investor possesses complete information. Future outcomes are unknowable. Price movements are noisy. Data is conflicting. In such ambiguity, social signals become disproportionately influential. A rising stock price is not merely data. It is evidence that others believe. And belief becomes contagious. Mirror systems and behavioral synchronization. Research in neuroscience suggests that humans possess mirror systems, neural mechanisms that activate when we observe others performing actions. While simplified interpretations of mirror neurons are often exaggerated, the broader concept is clear. We are wired to synchronize. When people around us express excitement, our emotional state subtly shifts. When others display fear, our own vigilance increases. Emotional contagion operates below conscious awareness. In markets, emotional contagion is amplified by price movement. Rising prices generate visible enthusiasm. News outlets amplify success stories. Social conversations reinforce optimism. Your environment signals confidence. Your physiology responds. Heart rate changes. Attention sharpens. Reward anticipation increases. The result is not a purely analytical decision. It is a socially synchronized response. Uncertainty intensifies imitation. Imitation becomes strongest when uncertainty peaks. In stable environments, individuals rely more on personal experience. In unstable environments, social cues dominate. This is why herd behavior is most visible during crises and booms, precisely when clarity is lowest. During market crashes, investors watch others sell. Selling becomes validation. Panic spreads not because everyone independently recalculated intrinsic value, but because visible behavior signals danger. During speculative manias, investors watch others profit. Buying becomes validation. Euphoria spreads not because everyone independently verified fundamentals, but because visible gains signal opportunity. In both cases, imitation reduces the discomfort of ambiguity. It answers the question, if others are doing it, can I really be wrong? Status and belonging. Imitation is not only about safety, it is also about status. Humans are deeply sensitive to social hierarchy. Aligning with popular movements can enhance perceived competence. Being part of a successful trend feels empowering. Missing it feels diminishing. This status dynamic plays a crucial role in financial markets. If your peers invest in a booming sector and you abstain, you risk appearing outdated. If your colleagues profit from a trend and you remain cautious, you risk seeming uninformed. The psychological pain of exclusion is real. Studies show that social rejection activates similar neural pathways as physical pain. That overlap reveals something profound. Social alignment is not optional for the brain. It is fundamental. Thus, copying the crowd is not merely about copying trades. It is about preserving belonging. The illusion of independent decision. Here lies the subtle danger. Imitation rarely feels like imitation. When investors follow the crowd, they do not think, I am copying because others are copying. They think, the evidence supports this move. And often, the evidence they see is the crowd itself. Price momentum becomes proof. Volume becomes validation. Popularity becomes credibility. The brain integrates these signals seamlessly into reasoning. The decision feels analytical. But beneath that analysis lies biological alignment. Collective intelligence versus collective error. Imitation is not inherently irrational. In many cases, crowds aggregate information effectively. Markets can reflect dispersed knowledge efficiently. Social learning can reduce individual error. The problem arises when imitation becomes reflexive rather than reflective. When social proof replaces independent evaluation. When the signal is no longer information, but momentum. At that point, collective intelligence can transform into collective error. This transformation is gradual. It does not feel dramatic. Each participant believes they are responding to rational signals. Yet the signals themselves are increasingly shaped by imitation. The crowd begins to amplify itself. Evolutionary mismatch. The core issue is evolutionary mismatch. Our brains evolved for small groups with shared environments and immediate threats. Modern financial systems are global, abstract, and digitally accelerated. In ancestral settings, copying the group reduced risk. In speculative markets, copying the group can magnify risk. The biological wiring remains the same. The environment has changed. And this mismatch creates vulnerability. Transition to markets. When Robert Shiller analyzed financial bubbles, he observed that they were not merely economic phenomena. They were social phenomena. Story spread, belief spread, participation spread. At the foundation of that spread lies the biology of imitation. Before narrative contagion takes hold, before FOMO escalates, before prices detach from fundamentals, the brain has already made a quiet decision. It feels safer with the crowd. Understanding this biological foundation is essential. Because if imitation is wired into us, resisting it requires more than intelligence. It requires structure. And before we explore how markets transform imitation into herd behavior, we must first examine how rational individuals become collective actors, and why resisting that transformation feels far more dangerous than joining it. Section 2. Herd behavior in markets. When rational individuals become collective. Herd behavior does not begin with irrational people. It begins with rational individuals responding to uncertainty. This distinction matters. When markets surge upward or collapse downward, observers often describe participants as greedy, naive, or panicked. But most investors inside the movement do not feel irrational. They feel informed. They feel responsive. They feel aligned with reality. Herd behavior emerges not because people abandon thinking, but because thinking becomes socially conditioned. What is herd behavior? Herd behavior occurs when individuals mimic the actions of a larger group, even when their private information or analysis suggests a different course of action. In markets, this means buying because others are buying, selling because others are selling, adjusting positions not solely based on valuation, but based on visible participation. Importantly, herd behavior is not always conscious. Investors rarely admit, "I am buying because everyone else is buying." Instead, they reinterpret the crowd's action as confirmation of their own thesis. The rising price becomes proof. The expanding volume becomes evidence. The popularity becomes validation. The individual decision feels independent, but its timing and direction are socially synchronized. Information cascades. One of the most powerful mechanisms behind herd behavior is the information cascade. An information cascade begins when individuals uncertain about a decision observe the actions of those before them. If early actors choose a particular direction, later participants may ignore their own information and follow the observed behavior. Imagine the first few investors buy a new technology stock. Observers assume those buyers possess superior information. They buy as well. The next wave interprets that momentum as strong evidence. They join. Soon, private doubts are suppressed in favor of public signals. The cascade builds. At some point, the majority may privately harbor skepticism. Yet publicly, everyone continues to participate. The cascade persists not because everyone is convinced, but because no one wants to stand alone. Price as social signal. Markets amplify herd behavior because price itself is visible and dynamic. Unlike most social signals, market signals update constantly. A rising price is not just an abstract number. It is a public scoreboard of collective belief. When prices increase, the message appears simple. The market agrees. This transforms price from outcome into argument. Investors stop asking, "Is this justified?" and begin asking, "Why is everyone else buying?" The upward movement becomes its own explanation. This feedback loop is powerful. Rising price attracts attention, implies increases buying, implies further price rise. The loop can persist far longer than logic alone would suggest. Institutional herding. Herd behavior is not limited to retail investors. Institutional investors are often equally vulnerable. Fund managers operate within career constraints. Their performance is measured relative to benchmarks and peers. Underperforming alone is dangerous. Underperforming together is survivable. This creates a subtle but powerful incentive. Align with consensus. If a manager avoids a popular asset that continues to rise, clients may question their judgment. If the manager participates and the asset later collapses, the loss is shared across the industry. The psychological burden of being wrong alone outweighs the financial burden of being wrong collectively. This dynamic reinforces herd behavior at scale. It is not ignorance. It is career risk management, fear, and euphoria. Herd behavior intensifies at emotional extremes. During euphoric bull markets, optimism becomes socially contagious. Success stories dominate conversation. Skeptics are dismissed. Doubt feels outdated. Investors may privately question valuations, yet the visible enthusiasm lowers perceived risk. If so many intelligent participants are buying, surely it cannot be reckless. During crashes, the opposite occurs. Selling becomes a visible act of caution. Fear spreads rapidly. Investors see red numbers and assume others possess alarming information. Selling becomes self-justifying. In both directions, emotion amplifies imitation. The psychological cost of independence. Resisting herd behavior is not merely a technical challenge, it is a psychological one. To stand against the crowd means accepting temporary underperformance, social disagreement, public skepticism, self-doubt. Contrarian investors often endure long periods where their position appears wrong. During that time, the crowd looks intelligent. Media narratives support consensus. Price momentum validates majority belief. Remaining independent requires emotional insulation. Without it, alignment feels safer. This explains why even experienced investors succumb to herd behavior. It is not that they lack analytical ability. It is that they underestimate the psychological toll of dissent. Why herding feels rational. Perhaps the most subtle element of herd behavior is that it often appears rational in the moment. If thousands of investors, including respected institutions, allocate capital in a particular direction, ignoring that signal seems reckless. The logic unfolds naturally. So many participants cannot all be mistaken. But history shows that they can. The dot-com bubble, the housing bubble, commodity manias, cryptocurrency surges. In each case, intelligent participants reinforced one another's conviction. Inside the movement, skepticism felt outdated. Outside the movement, it appears obvious. Collective amplification. Herd behavior becomes especially dangerous when combined with leverage and media amplification. As more participants join, prices move further. As prices move further, confidence strengthens. As confidence strengthens, leverage increases. The cycle accelerates. Media coverage intensifies interest. Success stories multiply. New participants enter not out of analysis, but out of observation. The crowd becomes self-propelling. At that stage, the original fundamentals matter less than participation itself. The fragility of consensus. Herd behavior creates temporary stability. As long as consensus holds, price movement appears smooth. Volatility decreases. Confidence rises. But consensus built on imitation is fragile. When a shock disrupts belief, the same mechanisms that drove collective buying reverse into collective selling. Information cascades invert. Price declines become signals of danger. Participants rush for exits simultaneously. What once felt safe in numbers becomes dangerous in numbers. The crowd that protected now amplifies loss. Herd behavior and narrative economics. Robert Shiller's insight adds another layer. Herd behavior does not spread alone. It travels with stories. Narratives give herding intellectual cover. They provide explanation, justification, and moral confidence. Participants believe they are not copying blindly. They believe they are acting on a compelling story. This integration of narrative and imitation makes herd behavior durable. It feels meaningful. Transition forward. Herd behavior reveals something fundamental. Markets are not purely aggregations of independent rational actors. They are social systems where perception influences price and price influences perception. Understanding herd behavior requires accepting that copying is not a flaw of weak minds. It is a structural feature of social cognition. The next layer of analysis moves deeper. If herding explains synchronized action, what explains synchronized belief? How do financial ideas spread so rapidly, so persuasively, and so convincingly that they override private doubt? To answer that, we must examine FOMO and narrative contagion, the viral spread of economic stories that transform collective movement into collective conviction. Section 3. Narrative contagion. How financial stories spread like viruses. If herd behavior explains why we move together, narrative contagion explains why we believe together. Crowds do not move randomly. They move with conviction. That conviction is rarely built on spreadsheets alone. It is built on stories. Robert Shiller introduced the concept of narrative economics to explain this phenomenon. He argued that economic events are not driven purely by interest rates, earnings, or policy decisions. They are driven by narratives, contagious stories that spread through populations, shaping perception and influencing economic behavior. A narrative is not just information. It is a simplified explanation of reality, emotionally charged and socially shareable. And like a virus, it spreads. What is narrative contagion? Narrative contagion occurs when a compelling economic story spreads from person to person, influencing behavior independently of underlying fundamentals. A story might sound like this. This technology is changing everything. Real estate never goes down nationally. This is a new era of permanent growth. This time is different. These statements compress complexity into clarity. They reduce uncertainty into direction. They transform risk into opportunity. Most importantly, they are easy to repeat. The easier a story is to communicate, the faster it spreads. And the faster it spreads, the more credible it appears. Stories reduce cognitive load. Markets are complex systems. They involve macroeconomics, corporate earnings, geopolitics, psychology, liquidity, and policy shifts. Processing this complexity analytically is exhausting. Stories simplify. Instead of evaluating dozens of variables, the mind adopts a narrative shortcut. A single storyline organizes scattered data into coherence. The AI revolution justifies these valuations. The housing shortage explains rising prices. Central banks will always intervene. These stories create structure where ambiguity once existed. Ambiguity is uncomfortable. Coherence is soothing. The brain prefers coherence. Emotional amplification. Narratives spread not because they are precise, but because they are emotional. Emotion increases memorability. Memorability increases transmission. When a story triggers excitement, fear, pride, or urgency, it becomes more shareable. People repeat it in conversation, post it online, and discuss it in media interviews. As repetition increases, familiarity increases. And familiarity breeds perceived truth. Psychological research shows that repeated statements are more likely to be judged as accurate, even when unsupported by evidence. This is known as the illusory truth effect. In financial markets, repetition transforms belief into consensus. FOMO, fear of missing out. Narrative contagion fuels FOMO. FOMO is not merely envy. It is a response to perceived collective movement. When a story spreads about extraordinary gains, early investors becoming wealthy, industries transforming overnight, unprecedented returns, participation feels urgent. The fear is not just losing money, it is losing position. Missing the story feels like missing history. Neuroeconomics suggests that anticipated social exclusion activates stress pathways. Watching others benefit while standing aside triggers discomfort. That discomfort pushes action. Thus, narrative contagion does not simply inform, it pressures. Bull markets and story reinforcement. In rising markets, narratives gain reinforcement from price movement. Suppose a story begins around a promising sector. Early adopters buy. Prices rise modestly. Media coverage increases. Analysts begin publishing supportive research. Social media amplifies gains. Each price increase validates the story. Validation attracts new participants. New participants push prices higher. Higher prices strengthen the narrative. This feedback loop can persist long after fundamentals weaken. The story becomes self-sustaining. Inside the loop, doubt feels irrational. Outside the loop, it later appears obvious. Media as multiplier. In earlier decades, narrative contagion spread through newspapers, television, and word of mouth. Today, digital platforms accelerate transmission exponentially. A compelling financial story can reach millions within hours. Algorithms prioritize emotionally engaging content. Extreme projections attract attention. Bold predictions receive amplification. This environment favors clarity over nuance. Complex caveats do not go viral. Strong claims do. The result is rapid synchronization of belief. Authority endorsement. Narratives gain power when endorsed by respected figures. When prominent investors, economists, or public intellectuals support a storyline, it gains legitimacy. Authority reduces skepticism. If credible experts appear convinced, independent evaluation feels less necessary. This dynamic is subtle. Investors may still analyze data, but analysis occurs within the frame established by authority. The narrative sets boundaries for interpretation. Why narratives persist? Narratives persist because they are socially embedded. Once adopted by a critical mass, abandoning a narrative requires social risk. Publicly reversing belief implies previous error. It may imply loss of status. Therefore, narratives linger even when contradictory evidence emerges. Participants reinterpret data to preserve coherence. Minor setbacks are dismissed as temporary. Critics are framed as pessimistic. Doubt is reframed as opportunity. The narrative adapts to survive. The new era illusion. One recurring feature of narrative contagion is the new era claim. Technological revolutions, financial innovations, or policy shifts are described as fundamentally altering economic reality. While genuine structural change does occur, narrative framing often exaggerates permanence. Historical cycles are dismissed. Valuation constraints are reinterpreted. Risk is reframed as outdated thinking. The phrase, "this time is different," captures this dynamic. It is rarely accurate, yet it is frequently persuasive. Contagion and collective confidence. As narratives spread, they influence not only beliefs but identity. Participants begin to see themselves as part of a transformative moment. They are not merely investing, they are participating in progress. This identity fusion strengthens commitment. Selling feels like betrayal. Skepticism feels regressive. Confidence becomes collective. And collective confidence becomes price momentum. The fragility of narrative systems. Despite their strength, narratives are fragile. They rely on sustained reinforcement. When external shocks contradict the story, earnings disappointments, policy shifts, liquidity contraction, cracks appear. If price declines break the feedback loop, belief weakens. Doubt spreads as quickly as enthusiasm once did. Negative narratives replace positive ones. Fear becomes contagious. The same mechanism operates in reverse. Narrative contagion and rationality. It is important to recognize that narrative contagion does not eliminate rational analysis. Investors still review data. Analysts still produce research. Institutions still conduct due diligence. But narrative framing shapes interpretation. Evidence is filtered through the dominant story. The story becomes the lens. And once a lens is widely adopted, independent perception narrows. Transition forward. Narrative contagion explains why crowds believe together. Herd behavior explains why crowds move together. But one deeper question remains. If stories are so contagious, and if prices validate belief, why do bubbles feel logical while they are forming? Why do intelligent participants defend valuations that later appear absurd? To answer that, we must step inside the bubble itself and understand why, from within, collective enthusiasm feels not reckless, but reasonable. Section 4. Why bubbles feel rational inside. A financial bubble never announces itself as a bubble. It does not begin with madness. It begins with plausibility. From the outside, history textbooks describe bubbles as obvious excesses, moments when prices detach from reality and speculation overwhelmed reason. But from the inside, during the expansion phase, participants rarely feel irrational. They feel early. They feel informed. They feel adaptive. This is the central paradox. If bubbles are so destructive, why do intelligent people repeatedly participate in them? The answer lies in internal coherence. Inside a bubble, everything appears to make sense. The internal logic of a bubble. A bubble typically begins with a genuine innovation or structural shift. Railroads in the 19th century, electricity in the early 20th, the internet in the 1990s, housing securitization in the 2000s, artificial intelligence or digital assets more recently. Each began with real progress. Early adopters see opportunity. Prices rise modestly. Gains attract attention. Media coverage increases. Analysts publish optimistic projections. Capital flows expand. At this stage, the narrative aligns with reality. Growth is occurring. Technology is advancing. Earnings may be improving. Participants do not feel reckless. They feel aligned with transformation. The bubble does not start with delusion. It starts with momentum. Price as proof. As prices rise, a subtle psychological shift occurs. Rising price becomes evidence of correctness. If the asset continues appreciating, skepticism weakens. Those who doubted begin reconsidering. Those who entered early gain confidence. New participants interpret the upward movement as validation of the underlying story. The logic evolves. Markets are efficient. If price is rising, informed participants must believe in it. If informed participants believe in it, I should too. Price transforms from outcome into argument. This is critical. In a bubble, valuation concerns fade because price itself becomes the primary indicator of truth. Rationalization loops. Inside a bubble, participants construct increasingly sophisticated rationalizations. Valuation metrics are reinterpreted. Traditional constraints are labeled outdated. Historical comparisons are dismissed as irrelevant. This industry has never existed before. Old metrics don't apply. Growth justifies higher multiples. Network effects change everything. These arguments are not always false, but they gradually expand tolerance for excess. Each price increase strengthens conviction. Each new high normalizes the previous one. Anchors shift upward. The rationalization loop works like this. Price rises implies belief strengthens, implies justification, expands implies more buying, implies price rises further. At no point does the process feel irrational. It feels adaptive. The role of authority. Authority figures often reinforce bubble logic. Prominent investors endorse the theme. Analysts revise target prices upward. Media outlets celebrate success stories. Influencers amplify optimism. When respected figures express confidence, hesitation feels misplaced. Even skeptics begin softening their tone. Authority does not create bubbles alone, but it stabilizes them. It reduces perceived risk. It frames participation as responsible rather than speculative. Social validation. As participation increases, social validation intensifies. Friends discuss gains. Colleagues reference opportunities. Online communities celebrate returns. Public discourse shifts toward enthusiasm. Opting out becomes socially costly. Imagine declining to invest in a rapidly appreciating asset while peers accumulate wealth. The pressure is subtle but powerful. Remaining cautious can feel like missing progress. This pressure does not require explicit persuasion. Visibility is enough. Seeing others profit activates both envy and fear. Fear of missing out is not merely emotional, it is comparative. Everyone else is benefiting. Inside a bubble, participation feels safer than abstention. This time is different. One of the most persistent bubble narratives is the belief that structural change invalidates historical caution. New technologies, new monetary policies, new global dynamics, each is cited as justification for elevated valuations. The phrase, "this time is different," has appeared repeatedly throughout history. And each time, the context felt unique. It is easy to mock this belief in retrospect, but inside the bubble, evidence appears supportive. Innovation may genuinely be transformative. Growth rates may genuinely be accelerating. The danger lies not in recognizing change, but in extrapolating it indefinitely. Humans struggle to distinguish temporary acceleration from permanent shift. Confirmation bias amplified. As enthusiasm grows, confirmation bias strengthens. Participants seek information that supports the narrative. Contradictory data is minimized or reframed. Negative indicators are interpreted as temporary setbacks. Skeptics are labeled pessimistic or outdated. Risk warnings are acknowledged but discounted. The psychological mechanism is subtle. Investors do not consciously suppress doubt. They reinterpret it, because abandoning belief means admitting potential error, and error becomes harder to accept as exposure increases. Collective reinforcement. Bubbles are collective reinforcement systems. Each participant's confidence strengthens others. Optimism spreads through repetition. Media coverage magnifies gains. Institutions allocate capital in alignment. The environment becomes saturated with positive signals. In such an environment, skepticism feels socially misaligned. If you raise concerns, you risk appearing out of touch. The crowd does not need to silence dissent explicitly. Momentum does it implicitly. Why it feels rational. Inside the bubble, several elements combine. Genuine innovation, rising prices, social validation, authority endorsement, emotional reward, narrative coherence. Each component individually appears logical. Together, they create powerful alignment. Participants are not acting without reason. They are acting within a socially reinforced framework of reason. That framework gradually expands to justify excess. The tipping point. Eventually, fragility increases. Valuations stretch beyond plausible growth. Leverage rises. Expectations become extreme. Small disappointments produce disproportionate reactions, but the tipping point is rarely predictable. Confidence erodes slowly, then suddenly. Once price declines break the feedback loop, the narrative weakens. Doubt spreads. Selling becomes visible. The same mechanisms that fueled optimism now fuel fear. The bubble bursts not because people become irrational, but because collective belief shifts direction. Aftermath and hindsight. After collapse, narratives reverse. Observers claim warning signs were obvious. Participants question how they could have believed. Analysts revise projections downward. And hindsight bias reconstructs clarity. But clarity rarely existed in real time. The same participants who now condemn the bubble once defended it convincingly. That is the power of internal coherence. Lessons from bubbles. The lesson is not that innovation is false or markets are irrational. It is that social proof and narrative reinforcement can stretch logic beyond sustainability. Inside the bubble, alignment feels safe. Outside the bubble, it appears reckless. This asymmetry explains why bubbles persist across centuries. Intelligence does not prevent participation. It often strengthens rationalization. Transition forward. If bubbles feel rational because social validation overrides independent doubt, then resisting them requires more than analytical skill. It requires emotional resilience, because standing apart from the crowd is not merely a financial decision, it is a social and psychological challenge. To understand that challenge, we must examine the emotional architecture of the crowd, the deeper forces of belonging, status, and identity that make collective movement so compelling. Only then can we ask whether true independence in markets is possible. Section 5. The emotional architecture of the crowd. If bubbles are sustained by logic stretched through narrative, they are fueled by something deeper: emotion. Markets are often described as rational systems driven by information and incentives. But beneath data and analysis lies an emotional architecture, a set of psychological forces that shape how individuals experience participation in a crowd. Understanding herd behavior requires understanding these forces, because copying the crowd is not only cognitive, it is emotional. Fear of exclusion. Human beings are wired for belonging. From early childhood, social acceptance shapes identity and safety. Evolutionarily, exclusion meant vulnerability. Modern society may no longer punish isolation with physical danger, but the brain still reacts to social exclusion with distress. Neuroscientific research shows that social rejection activates neural pathways similar to physical pain. That overlap is not metaphorical, it is structural. In financial markets, exclusion takes a subtle form. When others are profiting from an opportunity and you are not participating, a psychological gap opens. It is not just about missing money. It is about missing alignment. You are outside the shared experience. The discomfort may manifest as doubt. Maybe I'm being too cautious. Maybe I'm overthinking this. Maybe everyone else sees something I don't. Fear of exclusion does not require explicit pressure. Visibility alone is enough. Seeing others succeed creates tension between independence and belonging. And belonging often wins. Status anxiety. Markets are not only economic arenas. They are status arenas. Returns signal competence. Participation in successful trends signals awareness. Early entry signals foresight. When an asset surges, those invested appear intelligent. Those absent appear hesitant. This dynamic creates status anxiety, the fear of being perceived as less capable or less informed. Status anxiety intensifies during speculative booms. When dramatic gains circulate through social networks, the comparison effect becomes unavoidable. Colleagues discuss profits. Online communities celebrate windfalls. Media profiles successful investors. The individual who abstains may feel prudent internally, but externally invisible. Status is a powerful motivator. Aligning with the crowd preserves perceived competence. Shame avoidance. Closely related to status anxiety is shame avoidance. Shame arises when personal identity conflicts with public perception. In markets, being visibly wrong can feel humiliating. Interestingly, being wrong collectively carries less shame than being wrong alone. If everyone invests in a collapsing asset, individual accountability diffuses. But if one investor avoids a booming asset and it continues rising, the sense of isolation intensifies. This creates a subtle incentive to align with majority behavior. Shared error is socially tolerable. Isolated caution can feel like personal failure. Dopamine and reward loops. Beyond social belonging, biological reward systems play a critical role. Financial gains activate dopamine pathways in the brain. Anticipation of reward triggers pleasure signals even before profit is realized. In rising markets, frequent positive reinforcement strengthens engagement. Price increases to reward signals to increased confidence to more exposure. The cycle becomes addictive. Crucially, dopamine responds strongly to social comparison. Seeing others gain can amplify personal reward expectation. Thus, herd participation is not only socially comforting, it is neurologically stimulating. The crowd does not merely reduce fear, it enhances pleasure. Identity fusion. As narratives spread and participation increases, individuals begin to merge identity with movement. Investors no longer simply own assets. They become part of a story. They are part of the technology revolution, part of the housing expansion, part of the new financial paradigm. This identity fusion strengthens commitment. Selling feels like abandoning a cause. Questioning feels like betrayal. Group identity provides psychological stability. It transforms participation into belonging. Once identity attaches to investment, objectivity declines. The emotional cost of being contrarian. Contrarian thinking is often celebrated in theory. In practice, it is uncomfortable. Standing apart from consensus triggers doubt. It invites criticism. It risks prolonged underperformance. Even when data supports caution, watching the crowd advance without you tests emotional endurance. Contrarian investors must tolerate temporary isolation, social disagreement, self-questioning, delayed validation. These costs are not trivial. They explain why many investors who intellectually understand bubbles still participate. The pain of exclusion can outweigh the fear of overvaluation. Emotional synchronization. Crowds synchronize emotionally. Optimism spreads quickly in bull markets. Confidence reinforces itself. Skepticism diminishes. Similarly, fear spreads rapidly during downturns. Selling cascades. Panic feels justified. This synchronization reduces perceived uncertainty. If everyone around you expresses confidence, doubt appears misplaced. If everyone expresses fear, caution appears mandatory. Emotional alignment feels stabilizing, even when it increases systemic risk. Collective confidence and fragility. The emotional architecture that sustains bubbles also makes them fragile. Confidence is socially constructed. If collective mood shifts, emotional synchronization reverses. Euphoria turns into anxiety. Anxiety turns into fear. Fear turns into panic. The same social mechanisms that amplified optimism now amplify pessimism. This is why market reversals often feel sudden. They are emotional phase shifts. Emotional awareness as protection. Recognizing emotional architecture does not eliminate its influence, but awareness creates distance. If you can identify fear of exclusion, status anxiety, or dopamine-driven excitement in real time, you gain leverage over your response. The challenge is that emotion rarely announces itself clearly. It disguises itself as reasoning. You believe you are adjusting based on new information. Often, you are adjusting based on collective feeling. Transition forward. The crowd is not merely an economic phenomenon. It is an emotional system. Belonging, status, shame avoidance, reward anticipation, these forces shape participation more deeply than spreadsheets do. To think independently in markets, one must confront not only cognitive bias, but emotional gravity. Independence is not an intellectual achievement alone. It is an emotional discipline. And in the final section, we turn to the practical question. If social proof beats logic and emotion shapes participation, how can an investor think independently in a social market? Is resistance possible, Or is copying the crowd inevitable? That is where structure replaces instinct. Section 6. Thinking independently in a social market. If social proof is powerful, if narratives spread like viruses, if bubbles feel rational from the inside, and if emotional architecture pulls us toward alignment, then independent thinking is not a default state. It is a deliberate act. The uncomfortable truth is this: independence in markets does not happen naturally. It must be engineered, because the crowd is not merely external. It operates inside your perception. Step 1. Recognize narrative infection. The first defense against social contagion is awareness. Ask yourself, what is the dominant story right now? How often do I hear it repeated? Does rising price reinforce the story? Am I evaluating evidence or repeating a narrative? Narratives are not inherently false. Many begin with truth. The danger emerges when narrative replaces analysis, when enthusiasm becomes identity, when skepticism feels socially inappropriate. The moment you notice emotional urgency, excitement, or fear, pause. Urgency is often the signal that social proof is operating. Independent thinking begins with slowing down. Step 2. Separate price from value. Crowds treat price as validation. Independent thinkers treat price as information, not proof. Price reflects participation. Value reflects fundamentals. When price rises sharply, the question is not, why is this going up? The deeper question is, what expectations are now embedded in this price? As Robert Shiller emphasized, narratives inflate expectations. When expectations expand faster than fundamentals, fragility increases. Independence means asking uncomfortable questions. What must happen for this valuation to be justified? What assumptions am I accepting implicitly? What if growth slows? What if sentiment shifts? Price movement alone cannot answer those questions. Step 3. Design structural distance. Willpower is unreliable. Emotion is powerful. Therefore, independence requires structure. Some structural mechanisms include predefined asset allocation ranges, automatic rebalancing rules, maximum exposure limits to speculative sectors, written investment theses before entry, cooling off periods before large decisions. Structure prevents reactive alignment. When markets surge and excitement spreads, rules act as friction. Friction slows imitation. This does not eliminate participation. It reduces impulsive amplification. Step 4. Widen the time horizon. Crowds operate on short feedback loops. Daily price movements shape perception. Weekly headlines drive urgency. Quarterly performance comparisons influence decisions. Independent thinking stretches time. Long-term horizons reduce narrative volatility. Over decades, markets experience cycles of euphoria and fear. Recognizing this pattern reduces the emotional intensity of current movements. Ask, will this narrative matter in 10 years? Does this valuation assume perpetual acceleration? Am I reacting to noise or structural change? Time dilutes contagion. Step 5. Accept temporary isolation. True independence requires accepting discomfort. You will sometimes underperform during speculative booms. You will sometimes appear overly cautious. You may miss early gains. This is the cost of divergence. But consider the alternative. Participating in every narrative wave may feel comfortable in the moment, yet it exposes you to synchronized collapse. The crowd protects emotionally in the short term. Independence protects financially in the long term. The difference is timing. Step 6. Diversify against certainty. When conviction rises across society, risk concentrates. Independent thinking includes diversifying against prevailing certainty. If everyone believes in uninterrupted growth, consider downside exposure. If fear dominates headlines, evaluate asymmetrical upside. This does not mean reflexive contrarianism. It means calibrating exposure relative to consensus intensity. Extremes are signals. Consensus confidence is rarely infinite. Step 7. Maintain psychological calibration. Independent thinking requires emotional literacy. Notice internal cues. Do I feel urgency to act? Do I feel pressure because others are profiting? Do I feel fear because others are selling? Am I seeking confirmation from aligned sources? The goal is not suppressing emotion. It is recognizing when emotion is socially triggered rather than analytically grounded. Pause, reflect, reassess. Distance weakens contagion. Step 8. Embrace probabilistic humility. The crowd often speaks in certainty. This will change everything. This cannot fail. This is guaranteed. Independent thinking embraces probability. Nothing is guaranteed. Every narrative contains uncertainty. Every boom contains fragility. Probabilistic thinking tempers enthusiasm and moderates fear. It reframes decisions as exposure management rather than prediction. Step 9. Protect identity from markets. Perhaps the most subtle trap is identity fusion. When investors merge identity with narrative, becoming advocates rather than evaluators, objectivity erodes. Independent thinking preserves separation. You are not your portfolio. You are not your thesis. You are not the story. Detachment enhances flexibility. Flexibility enhances survival. The final reality. Social proof is not a flaw. It is human. Herd behavior is not stupidity. It is biology. Narrative contagion is not deception. It is social transmission. Bubbles are not created by fools. They are built by intelligent individuals aligning under shared belief. The challenge is not eliminating these forces. It is navigating them consciously. True independence in markets does not mean rejecting consensus reflexively. It means evaluating consensus without surrendering to it. It means recognizing when the crowd is informative and when it is amplifying itself. It means understanding that copying feels safe because it once was. But financial markets are not prehistoric environments. Safety in numbers can transform into synchronized risk. Closing reflection. Why do we copy the crowd even when we know better? Because belonging feels safer than isolation. Because stories feel clearer than uncertainty. Because rising prices feel like proof. because emotion moves faster than logic. Understanding this does not eliminate imitation, but it introduces choice. And choice, structured, disciplined, self-aware choice, is the foundation of independent thinking. Markets will always contain crowds. The question is whether you will move with them automatically or observe them with calibrated distance. That distance may feel uncomfortable, but over time, it becomes the quiet advantage of those who survive collective illusion.